Hello traders and investors, welcome back to the Trend Trader channel. In today's video, I would like us to talk about the difference between trading and investing. Before we start, I would like to ask those who haven't subscribed to please consider subscribing. And if you find value in this video, please smash the like button. As always, we appreciate it if we have a meaningful engagement in the comment section. So whatever that you believe is trading or investing, we're interested in hearing your views. How do you describe these two things? The reason why today we are talking about the difference between trading and investing, it is because these words are interchangeable in the streets where we discuss the stock market. Some people, they are investors or they call themselves as investors. Some people, they call themselves as traders. As a result, some people, especially beginner market participants, they struggle to decide whether to become traders or investors. So it doesn't matter what you call yourself, whether you consider yourself to be a trader or you consider yourself to be an investor. The end goal of every market participant is to make money from the stock market. Remember, companies go to the stock market to list there with an intention of getting money from investors, money that can be used to grow the businesses or any other aspect of the business. The investors themselves, at the end of the day, they expect to receive back their money. They can get back the benefit in the form of capital appreciation, or they can get the benefit in the form of dividends. So there are so many ways that investors can benefit from investing in the stock market or taking positions in the stock market. So firstly, we're going to start by talking about investing. What is investing? In a nutshell, investing is taking your existing resources, using those resources to generate more resources. In this case, in the context of the stock market, we are talking about you taking your money, buying shares. Now the shares, they become the store of value. And what you're expecting to get there, you're expecting the value of the shares to continue to grow, or the companies to perform well, to have profit, after tax profit, and then repay you as a shareholder in a form of a dividend. So with that thinking, we can look at investing as seeing an asset, buying that asset with the intention of deriving some form of money from that asset. That money can be you selling the asset in future when now the price of that asset is higher, or future, we don't know what will happen in future. In the meantime, you can derive income in a form of dividend income from that asset. The most common way of investing, and of which some people, they tend to confuse investing with it, is called value investing. So there are so many ways to approach the investing game. Value investing is identifying an asset that the share price of the asset and the value, the intrinsic value of the asset, there is a difference. Value investors will try to find assets that are selling at a lower price. That would be the share price of the asset, whereas they've already done the calculations of what is supposed to be the intrinsic value of the asset, or the fair price, if I can put it like that, the fair price of that asset. So if they see that the fair price of the asset is high, but the selling price of the asset is lower, the difference between the current share price and the value as per their calculations is what gives them the margin of safety. Maybe now the share price, the current share price, could be lower by 20 or 30% compared to the value of the share price that they have calculated of what the asset should be trading at. Then this gives them what they can consider to be a margin of safety. So each and every investor will decide how much margin of safety they want from a particular asset. That margin of safety can also be called a discount. So if, for example, we use a Sasol, the current share price of Sasol is somewhere around 300 Rand per share. A value investor will try to find what is the intrinsic value of one Sasol share. If they find that Sasol should be trading at 500, but it is currently trading at 300 Rand per share, then a value investor will then buy Sasol with the expectation that in future, anytime in future, it could be tomorrow, it could be a month from now, a year from now, 5 to 10 years from today. But the whole point is that they're buying at a lower price with the expectation that the share price of the asset is going to increase until it reaches that intrinsic value. Once Sasol starts to trade at 500, then it is a different case altogether. Now the investor will have to consider whether is it still worth it to continue keeping the Sasol shares or selling them, because that gap, that discount has already been closed. So, in summary, investing is finding an asset that is trading below its fair price. If you can get a discount or a margin of safety, then the investor will be happy to buy that particular asset. So, the benefit of buying that asset is that you believe that at some point that gap will be filled. So you will profit from the price difference between the current share price and the fair price of an asset. So that is investing. And value investing is one of the many styles of investing. So some people, they tend to confuse value investing as investing itself. Value investing is just an approach to investing. There are so many different ways that people can invest. Then now let's look at trading. What is trading? When we trade, we look at price action. What is the share price of the security or the asset or the company is doing? We are not interested in the prospect of that company, like if the business is going to be profitable in future, or if the business is producing products that we believe that people will want those products, therefore the share price is going to increase. That could be another way to look at the macroeconomic environment where the business operates, then taking a position. But investing, it is always has something to do with the current share price, not the price that we think that it should be. What is trading today, where it's supposed to be trading. No, we look at where the price is at today. When we open the chart, we're looking at the price, where the price is currently sitting as of today. Then we make a decision based on what we see from the past price action and the share price performance. And then we try to see what is where the share price is most likely to go to, whether the share price is most likely to go up or the share price is most likely to go down. So everything when it comes to trading, it revolves around the share price. But now why trading is also investing? Remember, I said that investing, you take the resource that you have, you are trying to grow those resources. So if I look at the share price of Sasol and I see that, okay, Sasol has been on an uptrend, then the next logical thing for Sasol share price to do is to continue go up. Then you take 10,000 Rand, you put it on Sasol. You invest in Sasol shares because you believe or you hope that the share price is going to move from 300 Rand per share to 400 Rand per share. Once the share price reaches 400 Rand per share, then you sell your shares. What you're going to get back, you are going to get back 100 Rand per share profit. That is profit. That is money. Nobody can dispute that. Whether people want to call trading as not investing, but you started with a small amount of the resource, you ended up with a higher amount of resources. Therefore, trading is also investing. Now, like I said, value investing is one of the many ways that people can invest. Technical analysis is one of the many ways that people can trade and invest, because technical analysis, it's just a tool. The same way you will go to a company website, download the annual report, and do things such as discounted cash flow model. The DCF is just one of the many tools that is available to market participant. Same thing with a technical analysis. It is one of the many tools that is available to market participant, to traders, and to investors. Anybody that can read the chart can find it useful. So there's this misconception that Technical analysis has everything to do with trading, and diving deeper into company financial statements has everything to do with investing. Remember, it's not about how much you know about a company. You can read everything that you want to know about Sasol, but if the share price is dropping, the share price is dropping. There's nothing you can do about it. You can look at the chart and say, I think that Sasol shares are oversold or overbought. Then the next logical thing, I think that once it's overbought, people are going to start to sell it. Then I just sell Sasol shares. But if people continue to buy Sasol shares, the share price of Sasol is going to continue to move up. So when we're in the market, irrespective of whether we call ourselves traders or investors, people who use technical analysis or people who use fundamental analysis, the report card that you get as a market participant is your profit and loss statement. It's not about how right you were or how wrong you were when you were doing the analysis. The end result is when you took a position on any company, irrespective of the approach, did you make money or did you not make money? So it is important that as a market participant, you understand the goal of being in the stock market is to make money. It's not to be right, it's not to be wrong, it's not to know how to calculate the intrinsic value of a company, it's not to attend events such as visiting company plans to see what is happening. It's not about plotting the perfect trend line or understanding Elliott wave Fibonacci extension. No, it's you understanding how do you make money and how do you lose money in the stock market. You make money if there's a change in share price. You don't want a security that has a stagnant share price, but it differs on the asset. If you are buying something like bonds or money market, the share price could be fixed. But remember, some of those things, they already have a fixed return, which is sort of guaranteed. So you are not that much interested in the share price moving. If it goes up, great. If it moves down, then it's a problem for everyone. Remember, when we are in the market, most of the time we are buying. So we are biased to the share price moving up. We are not biased. We're not always looking for the share price to go down, even though you can make money by shorting companies, meaning you sell at supposedly higher price and then you cover the position at a lower price. You can still make money like that. But now I'm just starting to stray away from the issue at hand. The issue at hand is just describing the difference between investing and trading. Investing is more about the asset itself. Then there are many factors that can affect the asset, the company, the environment, like the economic environment, macroeconomic environment. All those kinds of things can affect the price of an asset. When it comes to trading, we are looking at the share price. We are more interested in the share price of the asset, not the asset itself. As traders, we benefit from the change in share price. Yes, we can receive a dividend if we are holding a position, but majority of traders, they trade not because of the share price. They buy and sell a certain security because they see that the share price can potentially move in a certain direction. It's all about understanding how much risk you are taking when you buy that security. The risk is always going to be there, so you predetermine the amount of risk that you are willing to take, and then the potential reward, because there is no guarantee that the share price is going to move into the projected take profit level. But the share price can just simply go straight to your stop loss level and then you're gonna lose money. So when it comes to trading, we don't have what we call that discount between the fair price and the current share price, that a margin of safety. We don't have a margin of safety. Traders' margin of safety is the difference between the entry price and the stop loss, and understanding that gap. How much is that gap? Because that is the amount of money that the trader stands to lose if the share price move from the entry price and going to hit the stop loss. So if you want to have a chance of surviving in the stock market as a trader and as an investor, it is important that you understand the risk, which is the potential amount that you can lose, and then you make a decision based on that amount that you can potentially lose. But like I said, we are biased into things that are moving up. We buy into buying things, so it's easy for market participant to first think about how much money can I make in the stock market. Yes, it's possible to make money, but it's not guaranteed. But once you take a position, the risk of losing money is always there as long as you are holding that position. So that's the difference between trading and investing in a nutshell, and how investors can use all the different tools that are available at their disposal. It could be the financial statement, it could be calculating using all those complex models like discounted cash flow, or using something that other people consider to be simple or complicated. In this case, I'm talking about technical analysis. You can also combine all these things together in order for you to be able to make an informed decision. But remember, it's not about how much do you know about a company. You can read the financial statement, you can do the DCF model, or whatever model you use to estimate the fair price. You can then go and look at the chart to try and establish where the share price is moving or where it is supposed to move. Then you combine all that gigantic information. If the share price is going to crash, that whole time that you spent gathering that information, well, you're not going to get anything out of it. So just because you gathered enough information to satisfy yourself that you have done your research, still there's no guarantee that you're still going to succeed in the market, especially in the short term. And which is why most people, they end up saying that investing is a long-term game, because you could be wrong plenty of times in the short run. But if you start to pile up those investment over years, doesn't matter that you can put whatever number you want there, because just because you say investing is a 5 to 10 years game doesn't mean that you're gonna make money on year 5 or you're gonna make money on year 10. You can just struggle for the rest of your life as a market participant. It's possible. Or you can succeed in year 1 or succeed in year 2. So there's no point in sticking a specific number. That is just for you to feel better about yourself, to convince yourself when the going gets tough, because in the market, the going will get tough. When we talk about a smart money losing investors' money, it's not because at some point they change and then they become stupid. No, it's because the market itself, it is irrational, and we are trying to understand something that is irrational. So from time to time, we ourselves are going to be fooled by the market. So it's not something that you should take personal. You should go to the market, try to remove emotions by all means, just get the right amount of information that satisfies you. The information is never going to satisfy the next person. If you want to buy Sasol today, you should be satisfied that you are making the best decision for yourself, and prepare yourself of the outcome, whether you can make money or you can lose money. That's how the stock market works. So if people, they start saying that this company is going to do 1 2 3, it's going to succeed, all those things, that is the wishful thinking of the person that is presenting the information. It's not what is definitely going to happen in the stock market. So I've said a lot today. If you have any comment, suggestions, criticism, constructive or destructive, it is open. We are always open to hearing your views. We appreciate your views. We also learn from them. So make sure that you go to the comment section, you share whatever you think, what makes you make a decision to buy a company or to sell a company, what has worked best for you in the past, what do you think is the better approach for you in the stock market. Maybe share with us so that the viewers and subscribers can also benefit from your success in the market. We would like that. We also like to learn from you. That's it for today. We will see you on the next video.